Here's something nobody wants to admit out loud. Most Australians are one bad decision away from retiring with half the money they think they have. Not because of the markets, not because of bad luck, because of completely avoidable mistakes that are happening right now, quietly, inside accounts people haven't properly looked at in years. And by the end of this video, you're going to know exactly what those mistakes are, how to fix them, and the specific steps that will actually protect what you've spent decades building. Stay with me, because the last one on this list is the one that costs Australians the most money, and almost nobody talks about it. Let's start with the thing that sounds boring but is quietly destroying retirement balances across the country: fees. If your super fund is charging you 1.5% in annual fees, and plenty of funds still are, here is what that actually means in real money. On a $200,000 balance growing at 7% per year, the difference between a fund charging 1.5% and a fund charging 0.2% over 20 years is roughly $180,000 in lost retirement savings. $180,000. Not taken by a market crash, not lost in a bad investment. Quietly extracted year by year in management fees that most people never check because the number looks small on a statement. APRA, the Australian Prudential Regulation Authority, publishes annual performance data on every super fund in the country. The underperforming funds are listed publicly. You can check your fund right now on the APRA website in under 10 minutes. If your fund has consistently underperformed its benchmark net of fees over 7 or more years, that is not a temporary rough patch. That is the fund's permanent operating reality, and staying in it is a choice that costs you money every single day. Check the fees, check the performance, switch if the numbers say you should. Now here is something I want to come back to in a moment, because there is a contribution strategy available to every Australian with a super balance under $500,000 that can legally add tens of thousands of dollars to your retirement account in a single year. Most people have never heard of it. But first, let's talk about the thing that wipes out retirement savings faster than almost anything else: cashing out super early. During COVID, the federal government allowed Australians to withdraw up to $20,000 from their super across 2 financial years. Around 3.5 million people did it. And for many of them, particularly younger workers, that decision will cost somewhere between $150,000 and $200,000 in retirement savings because of what that money would have become through compounding over the following 3 decades. The money felt necessary at the time. The retirement impact is permanent. The lesson is not that people should have gone without during a genuine crisis. The lesson is that superannuation is not a savings account. Every dollar that leaves it early stops compounding immediately, and the further you are from retirement, the more damaging that interruption becomes. Unless you are facing serious financial hardship, your super should be treated as untouchable. Not because the rules say so, because the maths say so. That contribution strategy I mentioned, it's called the Carry Forward Concessional Contribution Rule. And if you haven't been maxing out your concessional contributions in recent years, this is one of the most powerful tools in the entire Australian tax system. Here's how it works. The annual concessional contribution cap, meaning the maximum you can contribute to super from pre-tax income, is $30,000 per year, including your employer's compulsory contributions. If you haven't used the full $30,000 cap in any of the past 5 financial years, you are allowed to carry forward those unused amounts and contribute them now, all in one go, as a tax deduction. So if you've had 5 years of modest contributions and you now have the capacity to make a larger payment, you can potentially put $50,000, $60,000 or more into super in a single year and claim the full amount as a tax deduction. Every dollar going in is taxed at 15% inside super rather than your marginal rate, which could be 32.5, 37 or 45% outside it. For someone on $120,000, the tax saving on a $40,000 catch-up contribution is over $8,000 in a single year. Real money returned to you through a completely legitimate strategy that most Australians have never used because nobody explained it existed. You need a super balance below $500,000 to access this. Check your balance, check your previous contributions through MyGov. And if the numbers stack up, talk to a tax accountant before the end of the financial year. Now let's talk about investment risk, because this is the conversation most Australians avoid until it's too late to have it properly. If you are in your early to mid-50s and your super is sitting in a conservative or cash option, you may have quietly made one of the most expensive decisions of your retirement journey without realizing it. Here's why. If you're 52 and planning to retire at 67, you have a 15-year investment horizon before you touch a dollar of that money. And statistically, you'll need it to last another 25 to 30 years after that. That is a 40 to 45-year total investment timeframe from today. Moving to cash or conservative at 52 doesn't protect your retirement. It guarantees your money grows more slowly for the next 15 years during the period when compounding should be doing its heaviest lifting. On a $300,000 balance, the difference between a conservative option averaging 4% and a growth option averaging 7.5% over 15 years is the difference between roughly $540,000 and $880,000 at retirement. That's $340,000 surrendered to fear, dressed up as caution. This doesn't mean ignoring risk entirely as you age. It means understanding that your investment horizon at 52 is not 5 years, it's potentially 4 decades. And your asset allocation should reflect the actual timeline, not the emotional one. Log into your fund, find out which investment option you're currently in, and if you haven't actively chosen one, you're in the default, which may or may not match your actual situation. If you're not sure what's right, that's exactly what a financial advisor is for. Let's talk about the age pension, because this is the piece of the retirement picture most Australians misunderstand until it directly affects them. The age pension is not a fallback for people who failed to save enough. It is a structural component of the Australian retirement system that the majority of retirees draw on in some form, and how your assets are structured in the years before you retire can determine whether you receive thousands of dollars a year in pension support or nothing at all. Centrelink assesses eligibility through both an assets test and an income test. Your family home is excluded from the assets test entirely. A single homeowner can hold around $330,000 in financial assets and still receive the full age pension. A part pension extends past $700,000 in assets for a single homeowner. For Australians approaching retirement with assets spread across super, savings and investments, small decisions about where assets are held, how they're structured, and whose name in a couple can shift your pension entitlement by thousands of dollars a year. This is not gaming the system. This is understanding it well enough to use it the way it was designed to be used. And the time to do that planning is 5 to 10 years before retirement, not the week you hand in your notice. I said at the start there was one mistake that costs Australians more than any other, and that almost nobody talks about it. Here it is: not having a plan, not a vague intention, not an assumption that the super will sort itself out. An actual written plan with a specific retirement income target, a specific portfolio structure to generate it, a specific withdrawal strategy, and a clear understanding of how the age pension fits into the picture. The Australians who arrive at retirement in genuine financial comfort are not always the ones who earned the most or invested the most cleverly. They are almost always the ones who made deliberate decisions with specific numbers behind them, rather than drifting toward retirement and hoping what they'd accumulated would be enough. A plan doesn't require a financial advisor, though for complex situations, one is worth every dollar. It requires sitting down with your real numbers, your super balance, your expected expenses in retirement, your anticipated age pension entitlement, your investment option inside super, and whether it matches your timeline, your contribution strategy for the years you have remaining. That conversation with yourself or with a professional is the most valuable financial activity most Australians never have. So here's what to do before you close this video. Log into your super fund and check 3 things: your current balance, your current investment option, and the fees you're being charged. Then go to the APRA website and check how your fund has performed against its benchmark over the past 7 years. 10 minutes. That's all it takes to find out whether your retirement savings are working as hard as they should be. If they're not, now you know what to do about it. If this helped you see your retirement picture a little more clearly, hit the like button and drop a question in the comments if you've got one. I read them all. Subscribe if you want more of this. There's a lot more to cover. See you in the next one.